Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management. Okay, looks like we're live. Joe Poshadiniak is away on March break with his family. So, Ken, take it away.
Awesome. Thank you, David. Okay. Thank you, Gilbert. Just quick disclaimer at the front end for Canadian investors. Contact us, visit our website. Same with our U.S. viewers, just same thing. Contact us through mcnichol.com just to talk to one of our portfolio managers. Looking here, S&P 500, I'll be pretty quick on these indice charts. Bit of a slide this week, reverse to previous support. It is one box away from a second straight sell signal. Obviously, the rocky markets continue with this Iran instability. S&P moved below its 50 and 150-day moving averages, approaching its 200-day moving average. It's on its longest weekly negative momentum streak since 2023, so even predating the, we'll call them the Liberation Day pullback. And then the overbought oversold, 52% oversold. That's the third straight week it's been oversold. First time since April 2025, mind you, it's also been heavily oversold over the same period. One thing obviously true with a bit of a pullback, we're seeing a bit of an expansion here on the trailing 12-month P ratio, obviously with the pullback I've noticed on FactSet there. So we'll have to see if that continues, obviously really being driven by a reduction in the price right now. Looking here at the NASDAQ, 3-box decrease over the week, back to support. It's 1 box away from creating a third straight sell signal. Obviously down year to date, down since last October, basically a lost 6 months. Momentum, longest negative weekly streak since last spring, overbought, oversold. 7 straight weeks oversold. That's the longest streak since last spring as well. We've seen some weak demand through 2026 for the NASDAQ, even predating this pullback we've seen. Only positive sectors really have been commodities, energy, staples, and semis, except for NVDA, if you look at the year-to-date charts. So something to look at there. And then P ratio obviously pulled back a bit, but still really elevated, even compared to other indices in the U.S. Looking here, the Dow, 11-box decrease week over week, and it created 3 new sell signals this week. So a really big pullback we've seen for the Dow. Nowhere near what we saw last spring in terms of magnitude, but a pretty prolonged decrease we've seen. And now it's trending for the first time since last spring, negative under that blue dotted line above the trend. Obviously, we've seen sustained weakness across all of the components within the Dow, basically. Momentum has flipped on a monthly basis due to the Iran sell-off. It's trading below its 50 and 200-day moving averages as of yesterday. I don't know if that changed this morning. Overbought, oversold, heavily oversold, about 81%. That's the third straight week it's been heavily oversold. So really weakness across the board in the U.S. we're seeing. And now up in Canada, pullback this week, but it did create some short-term support. Hanging in there a lot better than the U.S. indices on a technical basis, but also a fundamental basis. Only strength really for the TSX this week was energy and chemicals. Obviously, a lot of the miners have pulled back. Something to watch there. And then the overbought, oversold. This is the first oversold week since January 30th. Like I said, it's held up pretty well despite the equity weakness that we've seen in recent weeks. Something to really pay attention there for the TSX, especially with the fundamentals obviously pointing in the right direction. But if we get a deterioration in some of the technicals, it might join the U.S. indices. Looking here at the VIX, despite this, I guess we'll say, negative market or all of this negative sentiment, the VIX decreased week over week, and it created a sell signal, which is a positive trend for lower volatility. The target also reversed all the way down to 14.5%. That's the lowest in a long time. Watching this line, obviously, we've been on a trend this year upward. It's kind of linear / exponential positive relation. So we'll have to see if it does break below this in the coming weeks, or if we do get a next leg of volatility from some sort of event. But right now, it seems like it's kind of stabilized where it is. Bullish percentage charts, these two continue to move lower on the weakness in the U.S. market, really showing the lack of breadth and the breakdown of a lot of sectors right now: communication services, tech, and now even financials, which are being hit by this private credit sell-off. So you can see even the large caps, and then obviously the entire universe have kind of pulled back on the same trajectory. So really watching those closely. Percent positive trend. The Dow joined the NASDAQ with some weakness this week, although a lot more elevated in terms of the amount of companies within the universe trending in a positive manner. But really seeing the first breakdown that we've seen since last spring in those Liberation Day tariffs. Back then, there was a kind of a solution, trade deals. You obviously see things roll out with a tariff plan. Right now, it's kind of anyone's best guess of what's going to happen with this conflict right now, at least in the short term. Looking here at the Toronto Stock Exchange, like I said, technicals starting to break down for the TSX. Bullish percentage dropped by 6%. A lot of TSX companies flipping over in terms of strength to a bit of weakness. So we'll have to see if that sustains. And then really in the asset class rankings, the only gaining area was commodities. And the only sub asset class that gained was energy. And there was some weakness in precious metals this week, weakness in Latin America, and then the emerging markets, both of them. Only strength really in the domestic equity sector was utilities as well as energy. So really a rotation away from those high-tech cyclical companies into, I'll call them stable cash producing companies, especially at these energy prices right now. So interesting to watch that kind of unfold in front of our eyes. Quickly flipping here, this is the US dollar index, DXY, which we look at pretty regularly. Bottomed obviously back in early January, mid-January, and it's rebounded pretty heavily on the left chart, which is the 50-cent chart. On the right chart, it's the 1-point chart, which is the dollar chart. So a lot less movement on that one. But the one on the right is still only one box away from its first buy signal since November of 2024, when Trump first won, which kind of mirrors that move that we saw back in 2016. This is 2016 here. Trump won, B is November, and we got a buy signal, and then we got some sustained sell-off, which we've gotten basically this time, we've gotten over the last 15, 16 months in the second version of Trump. But after that, the dollar picked up some strength, and right now it's on the breakout here, so we'll have to really be watching it closely, but it does paint a similar picture to back in, I guess, when we saw the gain in strength was 2018, so we'll have to see if that continues. And then looking here, this is XLE versus the S&P 500. I just wanted to highlight this chart. This is obviously relative strength chart. When it's moving upward, energy has relative strength. S&P 500 when it's moving lower. And so obviously we got that long sustained period of the S&P 500 outperforming. And then 2022, energy obviously the strongest performing asset class. And then we've had a bit of a sell-off since in energy. But we got this first buy signal, and typically there aren't false signals on this chart. If you even date this all the way back to the .com era, there's some sustained strength in the energy sector. You can see 3 buy signals here, 2 buy signals here. This is a false flag, they called it, as well as here. But then if you predate this, there's usually some sustained strength within the energy sector on a relative basis. So something to watch. Interesting enough, when Dorsey Wright was highlighting a couple of these energy companies, EQT was one of them. We hold the EQT. We actually highlighted it last week in this presentation. But it's obviously a leader. But on a technical basis, it's not overbought. A lot of these energy companies that have surged in recent weeks are heavily overbought. You do not want to touch them with where they are in terms of their RSI levels. EQT has moved kind of nicely along its bullish line. It's sitting close to all-time highs. You could probably wait for a bit of a pullback, but you can see some nice, strong support lines there. It still scores at a 5 out of 5 right now, but a reversal lower could see it move to a 4 out of 5. And you could potentially get an entry point at one of these support lines. Dorsey Wright actually highlights this first support line as a nice entry point. I think 58, 56, or even 55 could be really, really strong entry points for investors with low exposure to the energy sector, specifically natural gas. And then just highlighting here, this is China's stockpiles of crude, which has grown, obviously, year over year. I think it's hit 1.6 billion barrels, something like that. And there's reports that, especially with the elevated price of oil right now and not being able to get enough oil out of Iran, that they're going to do a mass domestic release of their oil reserves. I'm not sure how likely that is, but just something that I read this week, I think in a Reuters article. And then speaking of, this is crude oil's price, obviously really volatile over the past few weeks. We'll have to see how it impacts, one, inflation. Yesterday's PPI actually picked up pre-conflict, so to the end of February, PPI beat consensus estimates by a pretty wide margin, and that's even before the U.S. and Israel, I think they, attacked Iran on the last day of February. So really the price of energy really hadn't priced in for producers as much as it will in March. So something to watch there. And then obviously there seemed to be some optimism from the Trump administration that they're going to get a lot of help at the start of the week in helping secure and transport these vessels through the waters around Iran, through the Strait to Hormuz. But I saw this week that Germany, Japan, and I think Australia, 3 of its closest allies, all rejected the proposal. So we'll have to see if that actually comes true, or if the Strait really just continues to remain basically fully closed, other than some shadow ships that are going under the radar and just going to China from Iran. Looking here, this is value versus growth. Value favored in the near term right now, according to Dorsey Wright, but growth for long-term strength for now. You can see currently when this chart is moving upward, growth is outperforming. When it's moving lower, the opposite. Right now, we've seen a short-term reversal where we've seen value outperform, but we haven't got that sell signal. For last time we got that was back in 2022, and you can see historically when value outperforms, it's for a bit of a sustained period. Obviously, other than 2022 when it was just 1 year where value outperformed completely. Just a couple more slides. I'll be pretty quick, but I just wanted to talk about private credit and financials. Talked about this in my weekly commentary, but we've obviously seen a massive pullback in the prices of private market asset managers, the Blue Owls of the world, the Ares of the world, the KKRs. Obviously, they're holding a lot of these assets that are worrying many investors, and their investors are worried they haven't been marking these assets at a proper NAV. You can see on the left, PIMCO's sees this as a bit of a wake-up call for the liquidity risks, especially in these liquid alts where we've seen some gates been put up by sponsors. They've had me do a bit of a study of the landscape because we're launching a new private fund and just looking at who's put up the gates, who's suspended redemptions, who's leaking redemptions out very slowly. Obviously, the big U.S. firms, some of them have done so, but a lot of Canadian firms, especially in the real estate market, that we're not surprised about. And then you can see on the right, this is the main piece that I wanted to talk about today. What is the most likely source of a systematic credit event? According to the Bank of America Global Fund Manager Survey, a private equity / private credit event, but a majority of fund managers believe that will be the source of a credit event. And I think we're already seeing a tick up in these default rates. Morgan Stanley believes it's going to reach 8%. I'm going to show you another slide which argues it's already much higher. And it's not just the private asset managers that are the ones that have these loans and this exposure to a lot of these software companies that are extremely levered. It's the largest U.S. financials in the U.S. are exposed to this private debt, close to about $300 billion, according to the Fed and Moody's. These large, I think there's 10 or 11 banks on this slide, but still have a great amount of exposure. Now, they are nowhere near exposed as these private credit managers, but still a decent amount. And you can see here, this is a slide from Fitch that just talks about private credit default compared to previous years. You can see the 2008 financial crisis. Obviously, private credit was a much smaller asset class back then. COVID wasn't really the crash that we saw in COVID wasn't driven by a financial event, more of a world shutting down, obviously. And then 2024, you can see the jump we've seen over the last few years. And according to Fitch, there's about an 18-to-1 liquidity mismatch in the $1.8 trillion market as of last year, which is private credit. Now, last slide, just an interesting slide, more or less, a little lighter of a slide, just perhaps some ideas of where to get exposure that is not in the U.S. or even in a developed market or a non-mainstream emerging market. Since really the U.S. started their trade war, we'll call it, or Trump started the trade war with China, and we've kind of reevaluated our relations with China, especially the United States, China's exports to the U.S. have fallen by about 43% over that 7-year period. Over the same period, exports from Taiwan to the U.S. jumped by about 340%, and then from Vietnam about 295%. You can see the major shift just unfolding in front of our eyes of the world economy and reconfiguring and kind of a splitting, I'll call it, of the East versus the West, and even how the U.S. and some developed nations get their cheaper products from manufacturing countries, kind of rotating away from China and looking for other sources for this cheaper manufacturing. So perhaps I know for a fact that Vietnam's market has gone on a bit of a run over the past few years, but perhaps some way to get some exposure in the Asian area without exposure to China and benefiting from this massive growth in manufacturing and exports that we expect to probably continue, and this trend to I think accelerate unless some major policy change happens in China and the U.S. reconsider their idea of their relations with China. And I think that's it for me today.
Okay, thanks, Ken. I think maybe we'd want to have Chris on next. Chris, are you ready?
Yep, there we go. Hopefully I'm coming through clear. I guess the big thing to talk about yesterday was both central banks, widely expected no change in rates. But what I found interesting was at the Bank of Canada press conference afterwards, Tiff Macklin was, pretty clear that given the economic data in Canada, which is extremely weak, he was saying that if there was not a war in Iran, that the Bank of Canada would be currently discussing interest rate cuts. And, that was less evident in the Fed meeting and the Fed press conference after that. They were both central bank heads talked about how, economists look through these energy spikes, whether that's a good sign or not. And the core measures of inflation, as we know, exclude food and energy, which are considered the most volatile parts of it. Powell also commented on his stepping down and potential resignation, and he said he'd continue in the interim until the investigations against him and the Fed were completed with certainty and finality. So he's certainly standing his ground on that one. The rates markets, this morning are selling off. At the short end, I think, people are really looking at the potential inflation coming through the system, which is mostly at the short end. Long end in the U.S. hasn't moved that much. In Canada, the rates, expectations in the market are for one cut at the September meeting. That's moved out. Used to be the July meeting. And give you quickly, just have to type it. That is for, it's not coming up, but the market was down to one cut in July as well. So obviously, inflation's coming through the system. Central banks' hands are going to be extremely, extremely tied with the longer this goes on and as the data gets stronger on the inflation front. And that's it for me. Thanks, Gilbert. I'll turn it back to you.
Yeah, Chris, just a question here with regards to your thoughts on how this oil shock might impact inflation numbers.
Well, I think, in the short term, very considerably. There's a number of analysts that are, tossing out, equating the movement in oil to moves in inflation, and, definitely a direct correlation there. I think the impact is that it really ties the hands of central banks that, their dual mandate, their lows to cut rates, even though the economies are going to slow, obviously, with spending going to consuming gas and food, and everything's really going to be impacted. So stagflation is the word of the day, I think. And but we're really in as we all know, in a period of tremendous uncertainty.
Right. Okay. All right. Thanks, Chris, for that. Sean, you're up next. So let's hear what you've got to say. And take it away.
All right, try to get this deck pulled up. Okay, hopefully everyone can see the deck. Take a look at the macro overview. Returns improved a little bit over the past week, mainly on call options on oil and some put option activity and future shorting on the indexes, the equity indexes. Right now, most of the returns are coming from short-term trading in indexes and oil. Still have this allocation to gold. Definitely questioning my allocation to silver now. I mean, it just got crushed today. This is, heading, we'll get into it in a second. Crypto market, still broken. Big picture, I think the midterms are really going to weigh on what we see happening over the next few months. Oil is obviously being priced for war. What's going on in the yen right now, it's gotten to a weak level where the BOJ has intervened in the past. I just hear continued chatter about the carry trade unwinding. That is going to be a problem for US that needs to issue even more bonds. So we could be having higher oil prices and higher rates. At a time when private credit is under stress, banks are going to be even more stressed with CR, commercial real estate. Things are looking a little bit more bleak than they were even just 2 weeks ago. Investment themes, everything's about the war with Iran right now. Oil as a global commodity affects everyone. A lot of the countries that are in Asia depend on it. They just don't produce any real meaningful amounts themselves. But I'm also seeing a deleveraging happening now, and we're seeing that take the gas out of things like silver, for example. Deglobalization continues. U.S. reshoring should speed up even more, but we're just not seeing that. And we're seeing continued losses in manufacturing jobs. Asset classes, clearly oil, popped. gold dropped. I think there's some of that deleveraging going on, but also the US dollar is getting stronger. And when that happens, the price of everything goes down, right? The US dollar is the contra asset to everything. Economics, very little has changed except for the potential impact on inflation due to rising oil prices. Recession was not in the cards for like the next while, but we're seeing cracks right now. We're on a light yellow alert for a recession now. The US dollar, I mean, that's some serious strength, going from like the low of 95 to 100. You might think, it's just nothing, but that is the biggest asset in the world, right? The basis for every value transfer that we do. It's up on flight to quality. The expectation is the administration wants a lower dollar long term to support reshoring and exports. They will reverse this as soon as they can. Gold, was the single strongest trend strategy out there. It's breaking down a little bit. This partly US dollar, partly deleveraging. Am I calling this a bear market now? Not yet. But, we could be in a sideways kind of risk off market for a while. Silver, I wish I could update this in real time. It's broken down even further right now. Like if I go and I take a look at where silver is trading in the futures market, I mean, we're at 68. It is down 12% in a day, right? A few weeks ago, I said my target was 50 to 60. We now have a 60 handle, right? This is now making sense from a commodity perspective. The speculation has just been like wrung out of this asset. Longer term, I like silver. I think this whole oil move is going to make every country in the world say, what can I use other than oil? And I think the move to electrification is going to, get the gas, if you will. And that will be like a decade move that won't be forgotten. Oil, it's all about the war. It's a global tax on consumers. We're going to talk about this. I expect it to be below 80 in the not too distant future. Talking to some people over the last couple of days, the back channels in Israel were that this was going to happen, and they talked about it as early as January. And hearing that yesterday, I looked back at my heat map, and the heat map basically was saying like oil is entering a different kind of market. All of that red downtrend due to global oversupply kind of got cut short. And so I think people knew this was coming and they were setting up for it. Maybe they didn't expect this degree of a pop, but it's pretty clear that when you have global oversupply signaled by everybody, and then we saw this uptrend in price, not demand, in price, something was afoot. And at the end of the day, we always have to listen to price. Now, the other thing that's popped up in the last couple of weeks is the rumor of a coup in Russia. They've cut the internet. They've apparently cut use of Telegram. Putin is now eyeing some of his former closest people with suspicion, specifically the former head of the military. If Russia had a coup, think of what that would do if they drop all of the sanctions and get a Western-friendly leader in Russia. Like, it is going to be another wrench in the oil market. If there's regime change in Iran and in Russia, we will be at a much lower level for oil. Like, this is potentially one of the biggest trades that we will have access to. The idea of basically being able to short oil from like this $100 level back to say 55. Oil impact, stole this chart from Ken. We've got a huge increase. The equity market does not like large increases in oil. However, we still have a VIX around 26, unemployment at 4.4%, tax refunds are landing. Fiscal spending due to this war is going to be absolutely juiced. The company to watch, NVDA, the earnings were good. Not great. The market didn't love it, but the market didn't hate it either. So that holds up. And this administration, let's remember, is made up of guys that follow the market very closely. Bessent, incoming Warsh, Lutnick, Trump, they all watch the market. I've got nothing really to say about rates. It's become a pretty boring market, frankly. The curve has flattened a bit. Yields are out, but only by less than 10 basis points in the past week. But private credit is still becoming a higher yield. And the banks now are wincing, as Ken mentioned, over the loans that they've made to private credit. So the private credit raised money, and then the funds actually borrowed money. So you got leverage on leverage, right? That just almost never ends well. It's a lot of fun when it works. And when it doesn't, they're looking for bag holders. US equity, we've gone weaker in many, many ways. We've got an inverted VIX curve. We've got weaker trend indications. We've gone from extreme fear of 23 to extreme fear of 17. Now, this is becoming a coiled spring. Resolution to the Iran war, we could be moving up very quickly and very dramatically. You may want to have a tail call towards the end of April, the end of May. We're in a danger zone with respect to the S&P. You can see on the chart, the volume, which is that histogram on the right-hand side, is very heavy, and we're below that volume. So we've got to get back above 68, 6,900 on the S&P for us to have that base continued so that we can see a liftoff. Otherwise, we're going to be trending into a correction, if not a bear market. The heat map, which is the blue, yellow, and green below the volume, we've gone to a red top to bottom. The trend indicators have gone from red top to bottom. This is a very challenged market. This is characteristic of a top. I'm not calling a top just yet, but the probability of us being post-top is rising very quickly here. Crypto, it's still broken. It's in a basing pattern. I can't recommend anybody get in. If you want to get in, contact me. There's some interesting plays. There's the Bitcoin Treasury Corp. There's an Ether fund out of Purpose with yield that's very substantial. But until we see this Clarity Act come through, it's just a challenged asset class. And right now, in a deleveraging market with rising yields, it's got a tough narrative. Stay away. Thought there might be a breakout last week, but there's no breakout. We're going back into the downtrend. You can see the heat map is turning red again. And at the end of the day, my question is, who needs Bitcoin? Right now, it's not working. We're in the fourth year of the 4-year cycle. Again, just reiterate, this could be at 40,000 in a couple of weeks. A big idea for the week is I've just subscribed to Perplexity Max to use Perplexity Computer. The nature of computing is changing. You're going to start using computers like toasters or microwaves. They're changing from these hardware dependent devices into something very different. You're still going to have guys that are nerding out over gaming rigs, but for the average person, what you're going to be able to do on a much, much lighter device is going through the roof. I'm doing stuff that I could barely believe possible by myself using these services like Perplexity Computer, OpenClaw, Claude Code, Claude Cowork. I'm now spending about $500 a month on these services. And it feels great. I feel like getting that multiple of that in productivity back. The big company that has some real challenges ahead is Apple. If Apple knocks it out of the park on integrating Google Gemini into Siri, and the recent MacBook Neo shows that they understand this trend is happening. They're trying to compete in the Chromebook market. This is going to be a big change. Like when everyone can just talk to their phone, their computer, and have it do exactly what they want, not have to worry about settings, getting real things done, making reservations, all kinds of things. I think that could be a big boost to the equity market. If they just keep blowing it, well, I mean, they're blowing it now, so it's not going to change much. So cartoon number 1 for the day. Come on, Donnie, I'm not going to be late for the party. So this is kind of how I'm seeing the relationship between Israel and U.S. right now. They took out the leaders with the strike and told the U.S., okay, we're going. They bombed the gas fields and then told the U.S., we're going to bomb the gas fields when the planes were like, about to hit the button. Trump doesn't want this. This is not his war. He's getting called out on it. His administration's getting called out on it, but he's got to be there because Netanyahu has him by the short and curlies. They want this over with. Trump wants this over with. But, the biggest question we all have right now is what ends the Israel-Iran war? I don't even put U.S. in the equation because they're just along for the ride. They're Robin to Israel's Batman. And the number one thing I come down to with this whole conflict is that Israel is all in on eliminating the theocratic rule of Iran. So if they can get to a détente with a government that looks like Turkey or frankly even Saudi Arabia, they would be happy with that. But if there's a theocracy, an Islamic theocracy, who has a fundamental tenet to end Israel, well, there's nothing that Israel won't do, right? The U.S. is not going to take out infrastructure, but Israel did. And now the big question is Karg Island. If the U.S. and Israel can take Karg Island and hold it, where 90% of Iran's oil and petroleum products are exported, unlikely that Iran is going to blow that to smithereens itself, even if there are U.S. soldiers there. If they can take that island and use that as leverage, that is as much a counterpoint to Iran's control over the Strait of Hormuz. Taking that island could be the pivot point if the U.S. takes that successfully. I would expect a significant rally. I think that is what we have to watch. And then this is the final cartoon. Marco, these are my choices, taco or falafel. That's it for me.
Okay, great. Thanks, Sean.
Okay, here we go.
Good morning, everyone, and welcome to this morning's brief update for March the 19th, 2026. My name is David Clark. I'm one of the analysts here at NASDAQ Dorsey, right? Mixed action for the indices we follow in the video here. Did see broader commodities in positive territory, those, though, crude slightly flat. And then from there, U.S. equities were in negative territory, leading the way to the downside. Russell 2000 down 1.6%, S&P equal weight down roughly 1.3%. So emerging markets and international equities down at 1.7% and 2%. Gold leading the way to the downside, down over 2% there. As for crude oil, we did see a reverse down into O's yesterday. Appears to be consolidating in this upper 90s, mid-90s area, at least for the moment. We'll see if it maintains that consolidation phase from here. As for gold, we did see, after seeing that sell signal there at 5,000 earlier in the week, we did see it drop down into the mid 4,800 range here, violating support there at 4,860. At the moment, looking at additional support at 46.60 for gold. As for the Dow, we saw that reversal down into O's, putting in another lower top here, along with giving a fifth consecutive sell signal here with that double bottom break at 46,400 as it fell to 46,200. Now looking at support there in the upper $45,000 range is our next line of demarcation. Russell 1000, the only other one U.S. equity index we saw additional chart action from as it reversed down into O's. Have seen 4 consecutive sell signals for it. Below 3,600 would be a fifth, similar to the Dow that we've seen there. As far as indicator action goes, didn't see a big drop in the 10-week, but did see enough to bring it below the October and November lows, down to 30% on the chart, bringing us to the lowest level since April of last year. As for the weekly distributions, measuring that percent of overbought, oversold, we are technically on the oversold side here, not quite as oversold as we got in November, but we're getting close. And really, if we look back towards last year, we saw a much more oversold stance, that minus 41 being a line of demarcation for sort of an oversold, somewhat washed out area. That's the last time we visited it, was in April of last year, before improving back above it that month as well. Individual earnings upcoming or have already come out today. Micron down about 5.5% after spending overshadowed a strong earnings report, currently trading about 437, showing the potential of reversing down from its recent highs, but coming back to this prior resistance, it appears in the lower 430s. So maybe overall healthy chart action outside of just the earnings report. So keep an eye on if we hold that 432 line to pull back to the middle of the trading band, a little bit of a different story, but if we hold there in the lower 430s, at the moment, it just looks like a healthy chart pulled back outside of the catalyst that's in it downward. Now looking at Alibaba, BA trading lower as well, down about 4.8%, trading at 120.
Okay, I don't care about company specific stuff, so I'll keep moving on here. You can hear me okay?
Yep, all good.
Okay, we've got a lot of charts to go through here, especially with SOT strategy, with Joe being away today on vacation. So let me start with Michael Coolbaugh, and he does some company specific stuff here on Delta Airlines. Actually, like airlines for the potential tailwind from the World Cup. However, surging jet fuel is a concern. DAL raised revenue guidance yesterday, but we need to be cognizant of the cost of side of things. Tronix Holdings. I've been concerned about our thesis on specialty chemicals, giving surging oil prices. That said, been pleasantly surprised by their resilience. Trox reacted with technical perfection with a strong bounce off support. Vista Energy, an Argentinian oil and gas play that just broke out to new highs. Now we know why Trump has been so interested in bolstering the situation in Latin America. That's just after Fred Hickey sold out of his, I think this company in particular. So, yeah, you got to be patient on these things. Baker Hughes, oil and gas services have been hit on the damage to infrastructure. CSLB commentary. Don't know what that means. That said, persistently elevated oil prices should eventually incentivize more rigs being put to work. I think this is one oversold uptrend that can be bought. Okay. Halliburton. The U.S. is said to ease more sanctions on Venezuela oil, which bolsters our case for services to benefit the Venezuelan regime change. And that's it for Coolbaugh. SOT strategy. I don't know what we have here, probably about 13 slides. Risk on, risk off indicator states that risk is off. As a reminder, my risk on, risk off indicator is currently registering risk off. And we have since early this month, buying and owning stocks will be higher risk as long as it remains on the risk off signal. One of the factors that will go into me having more confidence in any potential low would be for the indicator to flip back to risk on. Okay, we'll be keeping an eye on that. S&P 500 volatility snapshot, oversold. Yeah, so that's right down at its third standard deviation below the 50-day moving average. So that's really, or we're at a breaking point. And, we might have to be at the beginning of our safe harbor fund really kicking in positively, but that's too soon to tell. You can only tell that in hindsight. S&P 500 in between important support and resistance. So this is some more technical analysis. It's been an orderly decline. When we zoom in and look at the S&P 500, including the price action outside of the regular market hours, the decline since February 25th looks rather orderly and mechanical. The resistance line connecting the highs are held on a number of occasions and obviously will need to be broken before we have any hope of a bottom to this drop. So, yeah, I think we're in good shape. I'm just going to pause here for a second. No, I think I can carry on. Risk is more, this is your chart, looks like your chart, Gilbert. Risk is more elevated under the 200-day moving average, but can also act as support. S&P 500 is mixed as it gets. The market is getting more oversold in the intermediate term basis. And the low in late March has been typical on average. So this is a seasonal thing. Some slight divergence in the short term. Another factor in support of a bounce soon is that while the S&P 500 made a new lower low on Wednesday, the percentage of New York Stock Exchange operating companies above the 10-day moving average did not. This is a bit of a positive divergence. The NASDAQ 100, Russell 2000 also did not make new lower lows, although that could definitely change if the weakness continues into the end of the week. Oil trend higher, but remains below spike high. Rates, bonds still in range 2, so they haven't really moved one way or the other. And so then we go into some company names, one company name. So that's good enough for that. Yeah, I'll finish up on these slides, and then I'll just do the playbook, and then I'll wrap up, and then the next person can speak. The S&P TSX still in positive territory, but barely. The US is all in the red. China's barely positive by a couple percent. And Japan is really held in there nicely, and everything else is red. Oil continues to hold in there with basically flat over the day yesterday. Nat gas is really showing no change now, and gold's being hit in the past couple of days, and again today and this morning, as is silver. I'll cover the currencies and the interest rates on the in the playbook here. So Canada US dollar still unchanged, although this is a big change. The vertical price for the short-term indicator has gone from 78 cents down to 71. So it's looking like this is getting our Canadian dollar will weaken against the US dollar. We've had this US dollar spot index move up to 100 from 93, or excuse me, 99. It was 93 earlier at its bottom, and now it looks like it's strengthening. So as the US dollar spot index strengthens, that will put downward pressure on our Canadian dollar. And this has everything to do with the yen and mostly the yen getting stronger, and then the euro are the two largest components of the US dollar spot index. So stay tuned. Okay, so moving on to commodities. I think we've covered them a lot already on this call today, but it looks like oil's getting toppy at $95, measuring down to 81. Same thing with nat gas. The energy producers look like they could even roll over. Copper flat, uranium down, gold is definitely down. So both of these have changed week over week. So the futures measure down to 4,400 from 4,800 where they are now. And spot is at 5,000, measures down to 4,700. The producers all look like they're going to be heading down. So, gold is taking a pause here to figure out what's happening with the world. That's sort of positive news when it comes to the war in Iran. It's saying that maybe things can be resolved or shut down there sooner rather than later. But everything that I've been reading points to that this could be a dragged out mess. So, but at least the precious metals are giving us some pause for relief. Same thing, silver, platinum down. Yeah, no, Bitcoin looks horrible. It's at 71,000 now, measures down to 22,000. And then the rest of the crypto space measures up considerably. So we'll see. US money center banks look to be flat, and the regionals look like they've got some downside risk. Canadian banks still surprisingly look quite a bit stronger. Yeah, this private debt situation hasn't affected them or the mortgage situation and the condos. So I guess their broker dealers are really keeping them in there. Now, finally, finishing up on interest rates, this will be interesting to see what sort of change there has been. The 2-year looks the same, 5-year the same. 10-year measures up from 4.3% up to almost 5%. And the 30-year measures down. So same, but greater movement in the 10-year, which is showing a stronger economy, which is hard to tell with these unemployment numbers. But that's the end of what I have to say today. So Gilbert, I think we can wrap this up.
Okay, great. I think what I'm going to do is I'm just going to pull up my slide deck here, and we'll finish off the meeting here. So, a second. Okay, can you guys see my short report?
I see it. Yeah.
Okay, thanks. All right, so this is the short report for Thursday, March 19th, 2026. Here's the disclaimer. Again, taking a broad look at the S&P 500, this is something that we've been doing for a long time now. We can see that 200-week exponential moving average, which has acted as support. And if we do see a pull down, drawdown in the S&P 500, it's very likely that that will be the ultimate destination for it. It's what we saw in 2025, 2022, 2020, 2018, 2016, going all the way back. This is a well documented support level. And unfortunately, it's about 20-25% from where the market is right now. And so if we do see more of a pullback in the S&P 500, if the trend is broken, everything that's been happening over the last little while starts to come to the fore and influence equity prices, then we're not really as close to a bottom as it might seem. Taking a closer look here, again, this is the weekly, and we can see, a similar sort of pattern to what happened at the start of 2025. A nice rally moving higher, a little bit of back and forth. However, a topping pattern followed by a rolling over, and we're just right there at the precipice here. And so it's essentially make or break for the market right now, or at least for the S&P 500. Taking an even closer look, this is the daily chart of the S&P 500. We can see that we're right at the 200-day moving average here. That's an important technical level. We've come down to it after trading above it for some time, and this doesn't look strong here, right? I mean, this looks like it's breaking through it below. I see the market's sort of a rebound a little bit from where it was when I took this photo here today, but it's really right at that level. And we can see the last time that we did test this level from above was in early 2025, the result of which was a sharp decline under that level. Breaking below this level often triggers sort of sell signals for technical indicators, for technical traders and algorithmic traders as well. And so we have to be very careful when it comes to this level here. Another element that we've been looking at is the CAPE ratio. And last week I said that we look to be rolling over here, and that's essentially what we're doing right now. I mean, we breached the 40 level at the start of the year, and we've been coming down to that level ever since, even though the market's sort of been rotating out, trading sideways. We're now at the lowest level, I do believe, of 2026. So the lowest level of the year for the S&P 500, even though we're sort of in this range here, but you can see the CAPE ratio has been rolling over. I've been pounding the table with regards to credit spreads for a long time as an indicator. And one of the reasons why is because when they get this narrow, what seems to happen is there's not much more upside in the market, and then credit spreads start to widen. And that's essentially what we've been seeing over the last few weeks and even the last couple of months. As credit spreads have gone from a very, very narrow 2.5%, somewhere around there, to now well above 3%. The question now is whether this is essentially it. This is the end of it. And we can see historically that typically when you get a move out of this level of credit spread tightness, it's not finished at around 3%. Typically, we see evidence of it moving to 4%, sometimes even 5%, as it did in 2022. In fact, it got all the way up to 6% in 2022. 2020 saw a move up to 11%, but obviously that was a special circumstance. But that just goes to say that when you start to see widening from a tight credit spread profile, typically there's more work to be done. We took a look at defense versus growth a little bit earlier in the presentation. Yes, there's been sort of a pause here in terms of the rotation, even a little bit of a move into growth. But longer term, we can see that this is sort of a clear move higher away from growth and into defensives. And as we pointed out before, during moves like that, you do get pullbacks before sort of the market really gives up on growth and moves full on into defense. When we look at the NASDAQ 100, which is the growth index, we can see that we're right at the 200-day exponential moving average. And so if we are in a situation where we are going to get this continued rotation out of growth, it could coincide with a drop below this level, which the last time that happened was the 2025 tariff tantrum that saw markets decline another 20% from where they were at that point. So I think that that's not very unlikely. Market breadth, again, we pointed out with that red band that it's unlikely that we'll see market breadth continue much higher. Since then, we've seen market breadth move lower. And now the question is, where do we get a bottom when it comes to breadth? We're looking at the S&P 500 percent of stocks trading above the 200-day exponential moving average. And so that is a little bit of a broader market breadth indicator. Typically and historically, we see that we need to get down to this 30 level before we get to a bottom. If this is a move lower, and it's possible that that could be the case given the fact that we've been elevated for about a year now. On the near term, we're looking at stocks trading above the 50-day moving average, same sort of thing. Once we get this rollover, typically we don't get a bottom in breadth until we get down to this 20% level, sometimes even lower. And so this is what we would want to be taking a look at in terms of where the market's going next. Sean, you did say that you took this chart from Ken. This was actually, I think, my chart from last week, where all I did is I took a look historically at what happens when oil prices shoot up from under $70 a barrel to above $80 a barrel. What happens to the S&P 500? Historically, what we can see is that when that happens, the S&P 500 does suffer in the subsequent months. And those moves lower are typically very pronounced. And so, yes, what we've seen here, the move from oil of around 55 to 120 before stabilizing at around 100 is indicative of previous periods in the market that saw the S&P 500 decline. So we have more evidence suggesting that this is not really a place where we think that the market is going to move materially higher, especially in the near term. Elevated energy costs mean margin compression, less spending in other parts of the economy, and higher CPI. And so that's going to translate at a later time. However, right now, I think we're seeing it being expressed in the market. One thing I want to point out, Sean did point out that he talked about a yellow alert for a recession. I believe it, and I think that we have the data to support it. Given everything that's happening in the world, it's very easy to not be focused on the core economic indicators, one of which is U.S. unemployment, which has been declining precipitously for a while now. And what we're seeing is persistent negative readings in non-farm payroll growth. Now, the reason why this is important is because non-farm payroll growth and spending are the two main indicators that the NBER uses to determine whether the U.S. is in a recession. When we go all the way back to the 1990s, But we can see that when we have a slowdown in non-farm payroll growth, typically that coincides with a recession. In fact, every single time that's happened, it's coincided with a recession. But what needs to happen is not just a slowdown in the growth, we actually need negative non-farm payroll growth. So we need this line on the top right that you can see there that's been sort of flattening out. We roll over in order to confirm a recession. However, when we get a slowdown in non-farm payroll growth, just because a recession isn't immediately imminent doesn't mean that the economy and the market, the market with it, won't sort of signal that economic times are not as rosy as they used to be. When we take a look at this, this is just a change from a year ago. So this is the same chart, non-farm payroll, but we're just looking at it in terms of a change from a year ago. And what we can see here is that every time we dip into this negative territory from a year ago, that's when we get a recession. What we can see now is that we've been in positive territory since COVID, and we've been coming down now strongly, and we're right at this level. So if we continue to see negative non-farm payroll readings, regardless of what's happening in the Middle East or anywhere else, I think this is what is going to push the market in the direction that it has to go. Real personal income here, again, the second NBER indicator here. Historically, when we go all the way back to the 1970s, once this reaches negative territory, that's when we start to see recessions. Not always the case. We can see in 2022, we got into negative territory here, but we did not have a recession. That being said, we did have a material market pullback with, I think, the S&P 500 declining 25% and the NASDAQ 100 somewhere in the range of 35%. So once we get into this negative territory when it comes to real personal income, we could see a market correction continue. And it makes sense because with less income, people have less to spend. So if this is a concern for you, if you're interested in some sort of downside protection and want to prepare for the inevitable, we do have a solution through our partners at Universa. So please reach out to us if this does fit your profile. So that's it for me this week. So what I'll do is I'll just wrap up the meeting here. Thanks, Ken, Chris, and Sean for the contributions. And thanks everybody for watching. If you are on YouTube, please remember to like and subscribe and comment if you have any questions. And thanks for joining us, and we'll see you next week. So have a good one.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.